Hi, and welcome to Stock Market for Beginners. This is a course by a beginner for beginners. I am not a stock market guru. I am not a trader. I am a regular salaried class person just like you. And this course is also for people who are like me. So, who are you? You are a regular salaried class person, or a small businessman. So this is a course for you, or this is a video recording for you that would provide you necessary advice, guidance, warnings. It would tell you where to get started, which shares to invest in, and a very basic investment strategy on how to survive in stock market. Okay, so this course is for you if you are a small investor. So you are a salaried class person who makes small savings sometimes, and they would like to, you know, learn to do some business or some investment. Um, you are a retired person, but you are busy in your job all your life, and you don't know how to do business, and you don't know how to invest in stock market, but you want to get started because for you this is a kind of business that you can do with little effort. You might be a retired person who has been invested in stock market, but it's not their domain. You don't know the basic of investment and so on. So you want to do that, okay? You might be someone like me uh, who is interested in investing in stock market, but they don't really have the knowledge and skills, and they want to improve it from time to time. So they do invest their time to learn how to do better uh, than they are doing currently now. So let's move on. So warnings: stock market is not a regular fixed income scheme. So market is would not give you monthly income. So you should not invest your savings uh, if you are looking for regular income. So you should go to national savings or some other scheme. I'm talking in context of Pakistan and Pakistan stock market. Uh, Before you move forward, you should realize that in stock market, many people do lose their lifetime savings. So it's a very dangerous game if you are not prepared for it. It can be a very rewarding game if you have the time, patience, and skills to play it. So it's a dangerous game if you have not played this game, and if you don't have mental psychological skills to play this game. So for example, you are a heart patient, you get stressed easily. The market was at 44k level when you get started with investing, and now it is at 32k level. You have lost 40% of your investment, and you need the money for your to build a house or to marry your daughter or things like that. It would give you a lot of stress. So before you get started, I mean, wherever you are today or tomorrow or maybe whenever, you have to take these factors into account, that stock market can go down and it can wipe out 50% of your investments. uh, and what you want out of it, do you need regular income? If you need regular income, then go to national savings, buy Behbood certificates or something like that. Don't invest in stock market. Okay, you might be someone who loves gambling, and maybe you do it for pleasure, small time, and so on. And you go into stock market with your investment, and you start making big bets, uh, like a gambler, but you are really not a good gambler. So stay away from stock market. In stock market, it is really easy to get excited, so watch yourself. Stock market is not a casino, and you might not be a good gambler as well. So stay away from stock market if you are looking for regular income. uh, if you are a bad gambler, and if you are not yet prepared for this game, or if you are not strong enough physically, mentally, psychologically, uh, to to be able to bear the stress in the stock market. So don't invest in stock market if you don't have the desired stamina, patience, and health. Stock market is not a 2020 game. So stock market is not like you invest in this today, and by end of the day you are going to get huge profits, or by end of week you are going to get huge profits, by end of month you are going to on huge profits. So stock market is not a 2020 game. It's not a one day. It's not a get rich quick scheme. It's not a 5 day test match. It's not a monthly income scheme. So you have to keep all these points in mind. Stock investment in stock market can take 5 to 10 years to reach their true potential. So I've heard that there were investors in stock market before the World War II started, and you know uh, after the World War started, obviously there was the stock market closed down, or I mean it was at such a low level that they could not sell it, and you know they had to wait for 5 years or more before stock market started again, and slowly maybe after 10 years it pushed uh, you know uh, it really attained its previous levels and so on. So there are investors who invested in stock market for over 40 years, and they might have invested in a single company. So it really requires patience, a very high degree of patience. So investors who start early in stock market, it's a good idea. So you should start, I mean, your 20s, 30s, and you should develop a true understanding of companies that are going to last another 30 years, 40 years, and these are the companies that you should be investing in. Okay, before you get started, you have the funds uh, that you can spare from your regular needs, uh, and you have the stamina, you have the time to invest in stock market. So let's get started. So first thing first, only invest funds that you can spare from your expenses or needs for next 5 or 10 years. So assuming that you are a retired person and you have 100,000 rupees or 1 crore rupees, out of these 1 crore rupees, you are going to need, let's say, 50,000 monthly. So you invest like 50 or 60 lakhs or whatever in in national savings, bamboo certificates, defense savings certificates, where you would get the regular income for your monthly expenses. So you have maybe 2 million or 3 million to invest in a stock market. So that's as much. I mean, this is your risk aptitude, and this is as much as you should invest, not more than that. So make sure that you can invest small amounts of your savings on regular basis in stock market. So apart from investing, a small but significant portion of your uh, savings, like I mean 1 million, 2 million, 50,000 rupees, 100,000 rupees in stock market that you invested at the beginning. Uh, Stock market would not be viable for you if you cannot invest small amounts at a regular time, and I will explain to you why. So if you invest one time and you cannot invest again, and you are waiting for that, but that time that you chose to buy shares, you know it was not an ideal time, in the sense that prices were too high, and they then from that point onwards they went down and down. Then you should not be investing in stock market. So stock market requires you to invest at regular intervals. Okay, choose uh, the next thing is that you should choose one of the top brokers and not small brokers with strong financial background and great services, especially if you are investing in Pakistan. In Pakistan, there are lots of small brokers uh, that do not and cannot provide good services, and they are not very strong, and their checks, internal checks are not very strong. So you know there are frauds with investors. So their traders sometimes would sell your stocks without you having any knowledge, and that would destroy you. I mean, you would think that stock market is not a good place. Stock market is a perfectly good place for small investors, but you have to choose one of the top brokers and not the small brokers with bad services and poor checks and all that. Don't go for trader option and choose to trade yourself. So when you go to a broker, let's say you go to RFIB, you go to some other big broker, they would give you two options. You can choose a trader or you can trade yourself. So normally, if you are not looking to trade daily, and you would be trading once in a month or after 2-3 months and so on, like a normal sane person does, then you don't need a trader. So, and it is also a safe option to trade yourself rather than having a trader who might do some trades that you don't want to, or who might encourage you to do trades that you should not be doing. So rather than going for a trader, get necessary training before you get started. So there are trainings available online, there are trainings available at some institutions, or I mean you can study the stock market and learn about it on YouTube and other places, and then get started with. Once you have made your mind to invest in stock market, then the next step is choosing the shares that you want to invest in. So first thing first, you should have the time and ability to study annual and quarterly reports of the companies that you want to invest in before getting started. So if you don't have a reading aptitude and you don't read regularly, so you are into reading newspapers, daily news, and you go into companies' websites and you study a quarterly and annual reports, then you are the right person to invest in stock market. Stock market is not for totally ignorant people, people who cannot read. I mean, illiterate people. Stock market is not for illiterate people. It is for people who love to read and study different companies, different businesses. They try to understand them. So if you are that kind of person, then you should be investing in stock market. So in general, you choose share with high and rising dividends, earnings, return on investment, and potential for growth in share prices. So you go and study shares. So one way to study shares is you can go and look at different shares on PSX website. So that is dps.psx.com.pk, and you would see various shares. You can watch various shares as well. So you can go to any shares and look at their quarterly earnings, their annual earnings. You can look at their earning per shares. You can look at their dividend per share, and so on. So invest in shares which regularly pay dividends, which have good earning per share, and if you study their annual and quarterly reports and compare it and them with other companies in a similar sector or in different sectors, you would realize that these guys are doing good business, they are earning good money, so you can start investing in such companies. So another thing that is very important is ordinary investors, the salaried class investors, they should not be investing in more than 5 to 10 shares. The reason being that the shares, the companies that you invest in uh, would require further support down the line in future. So the share that you buy for 20 rupees today might be worth 10 rupees tomorrow, and you might want to invest again in that share. Investment strategy. So now that you know who you are, where you should be investing, why you should be investing, and why you should not be investing in certain shares, or why you should not be entering into stock market. So you understand that. Once you understand and you are convinced that you have the right aptitude and resources to invest in stock market, then you need some basic investment strategies. Here I am not going into complex charting techniques and investment strategies that professionals might recommend, because people like you and me may not be able to follow those, or they may not have the right tools to implement those strategies. So let's formulate. Okay. Investment strategy for small investors. So small investors cannot think and act like day traders or institutional investors. They don't have the same capacity, they don't have the same training, they don't have the same amount of money or funds available, and they have a different risk aptitude. So you cannot be, like that. They are different species. Typically, a small investor should invest with a long-term vision and strategy. Although this is not absolutely essential, but should be your, behavior most of the time, right? For most of your purchases or trades or shares. So, do not invest in shares with very high prices. This is one of the fundamental advice. Something which is already at a peak price, you should not buy that. You should look at the charts and you should see, okay, if some share is already at 6-month high or a year high or 3-month high, maybe you should not invest in that. Or if it's a blue chip share and it has very high price, then maybe you should stay away from that. The reason being that if a blue chip share falls, then it can hurt you very badly. So whatever you invest in, you have to think about both sides. It has a potential for going up, but it also has the potential for falling down. So stay away from shares that are already at their peak prices, because what what goes up can come down, and if it comes down from a very high level, it's going to hurt you badly. Wait for the right time before executing buy or sell decision. So you might like a blue chip share, but you have to wait for the right time for its price to be at a certain level to buy it. Buying shares when market is at 28k or 32k is better than buying shares when market is at 44k level. So that's very important. Market might be very bullish and it might be doing very well at 44k level, and everybody jumps in, but when the market is at 28k level or 32k level, and it is it has a very negative sentiment, it has a very bearish sentiment, and nobody wants to buy anything. That's completely wrong. So buying shares at 28k level or 32k level is better than buying shares at 44k level. That's the right approach. That's the right mindset. So simply, if you buy a product at 50 rupees and after 1 year the same product is available for 25 rupees, then it is better to buy it, rather than waiting for that product again to go to 50 rupees 50 and then buying it, you know. So the basic rule is buy low, sell high. So whenever a product is at, at a discount price, go for it, after studying the, you know, current situation of the product and so on. So if the company is doing well, there's nothing wrong with the company, it has a good future, it is, its APS is good, it's giving dividend and all that, then buy that product. I mean, in stock market, nobody knows what's going to happen tomorrow. In real world, nobody knows what's going to happen tomorrow. So you have to buy things when they are being offered at a discount and they are perfectly good products. So, like in previous slide, I was telling you about, why it is important to buy low and sell high. So when market has a negative sentiment, and prices of the shares have come down, then that might be the right time to buy. So timing is most important in share price market. So rather than jumping in when the market is really bullish and the prices are very high and inflated, so look for a timing when market has negative sentiment, it has it is bearish, and prices are really down as compared to 3 months 6 months level, then buy the shares, buy whatever products you like. So sometimes you have to wait for shares to fall down to certain optimal levels before you buy or sell those. So never buy at shares at their peak prices, or try to avoid buying shares at the peak prices, and wait for the right or fair prices before buying any shares. You can always improve your timings by buying a share at different price levels, or stock market levels, and at different points in time. So there is in stock market, some people say, and they say it rightly, there is no right or wrong time, or right or wrong price to buy something. So if there is a good product like Coca-Cola, or Microsoft, or Yahoo, or Google, or NetSol, and you like that product, you are confident about future of that product, then you have to really keep buying that product at different prices and at different points in time. So for example, you bought 2000 shares of ASL at rupees 28 in March 2018, then you again bought 2000 shares of ASL at rupees 18 in 2018, because the stock market was down and sentiment was down, so prices of the shares were low, so you bought it again, and then you bought it again, at rupees 28 in January, and so on, and you went on buying that product for 3 years or 5 years, and ultimately the market recovered, the company picked up, it started earning good profits, and it started giving good dividends, and then maybe after 5 years, after 10 years, the same share of ASL was worth 200 rupees or 300 rupees. It had grown up so much, and it was such a strong company. So then you sell it. So that's why being patient is very important. Being sticking with your choices if they are good is very important. Studying the prospects of a company, their performance is very important. So you should never look at stock market every day and start worrying about it. You should just study your choices, make up your mind, and come back to those choices after 3 months or 6 months, and if you have made a right choice, then stick with it, and go on investing with that for 3 months, 6 months, 5 years, and ultimately you will. Okay, so how you build your portfolio? So building your portfolio is part of your investment strategy. Your portfolio should have shares from diverse market sectors, including cement, fertilizer, steel, software industry, petroleum, etc. So you should never invest in a single sector, because if that sector goes down, then you will have nowhere to hide. So what really usually happens in stock market is, maybe the banking sector is doing very well because a lot of money is coming into banking sector due to government policies, or maybe steel sector or cement sector is doing very well because government is encouraging exports and they are discouraging imports and so on. So that's how stock market and real world business is working. So you really invest in different sectors so that you can deal with market turbulence, government policy changes, and so on. So shares that are blue chip today might become garbage tomorrow, and vice versa. So you cannot invest in a single share, because if you do, then you might end up losing all your savings. So Shell, a blue chip share, has lost more than rupees 200. It was at rupees 350 per share last year, and now it is like rupees 150 per share, and it has made huge losses. And we do expect that it will lose further value. It might be under 100 in couple of months or couple of days, and so on. So that's how it works. I mean, it does not mean that it is a bad share. It will definitely recover from its losses. It may be 6 months, it may be a year, and it would regain its value. But right now, it's really a bad investment. So keep your exposure to garbage shares to minimum. So garbage shares are those shares which might be companies which might be making losses, and their share prices are very low. Typically their share price is less than rupees 5, and so on in Pakistan stock market. So shares not giving a dividend, companies not declaring profit, or companies not publishing their reports, and so on. So these are the kind of shares that are garbage shares, and you should stay away from those. Typically people who are gambling in stock market would buy such shares. So you would usually see lots of bets on such shares. So some of the very popular shares that have huge volumes in stock market, they are really garbage shares. They are not likely to give you something positive. They can give you a huge shock every now and then. So people are buying them based on speculation rather than real information. So stay away from shares that are very hot, and people based on some speculation, and people are betting on them. So stay away from betting. So how would you manage your investment? What would be your strategies? So there are two basic strategies that you can follow. One is averaging strategy, and the other is stock reversal strategy. Averaging strategy. So the idea behind averaging strategy is that stock prices and stock markets, it would keep moving. Today it is at 50k level. Tomorrow it might be at 3 months time it might be at 40k level or 30k level. 3 months after that, when eventually it would come back to 40k level or 50k level, or even it might go up to 60k level, and so on. So share prices and stock market both would keep moving. They would keep changing. So they don't have any fixed point. So stock price or direction of the market does not always tell us truth about health and strength of the business. So there are many businesses that last year were doing expansions and they have completed their expansions, or they are about to complete their expansion. So they are essentially doubling their production, and the government policies really suit them very well. So for example, the government is discouraging dumping of products such as steel, and imports of the products such as vehicles and so on. So they should be with double production, they should be making better better profits and so on, despite market not being very positive. So they are still able to sell their products, and they will make good profit. So you should not just look at the price that is today. So last year you were buying that share for rupees 20, and now it is like rupees 10 or less than that, and the situation of the company is probably better than it was last year. So you should buy that share. I mean, one for reducing your average price per share, and the other is uh, the product is actually better than it was last year. So you should if you don't put sentiments into it, you should be buying that product. So future is unpredictable. There might be war tomorrow. There might be market meltdown. Maybe the government policies will change. We don't know about that. So that's another reason that we keep investing in those shares or in those stocks which are meeting our expectations in terms of performance, and their share price is lower than what it was, or it may be even higher than what it was. So shares that meet our performance criteria, we do invest in them, and that averages out our share price. Being ordinary investors, we do not invest based on daily trading mindset. So we invest with a mindset of 3 to 5 years, 10 years. So if a company is doing well, we keep investing in those companies. In the long run, every stock price that you have will beat all the predictions and market trends. So if you invest in some product at rupees 20 and you buy it at 15 and 10 and so on, or if it goes to 30, you keep buying it, then you would always be have a price advantage against the market. So if the market is trading at 50 and your average price is at 25 or 20 and so on, then you are well ahead of the market. It can't beat you that easily. So that's why averaging strategy works for most people. For those shares which have a long-term future and which have traditionally a good performance and so on. So another thing that is very important is small investors do not invest in large number of shares. So you are not a trader, you are not a fund, you are not an investment company. You invest only in limited number of shares. So maybe 5 is a very good number, but if you have time and you have investment available, then maybe you should invest in up to 10 shares, but not more than that, because being a single man company or business, you cannot really study that many shares. You cannot take into account all the changes going on in the market. So 5 would suit you best, but 10 is the maximum that you should go. Keep investing in stocks after suitable time interval. So it is not like you invest in a stock every month, but maybe after 3 months or 6 months, you should review the performance of your stocks and look at which shares are giving you better returns, are performing better, and you should invest in those shares. So you should typically reward shares that that perform well for you, and maybe reward less or invest less in those shares which are not performing according to your expectations or your future plans and so on. So the strategy of averaging down involves investing additional amounts in a financial instrument or asset if it declines significantly in price after original investment is made. So one thing that I have told you is that you have target price for any stock or share, and if it goes down, then in that case you have another target price, and if it goes up, then you have another target price, and so on. So for example, we were investing in NetSol, and we bought 1000 shares at 112 rupees. So that was our first investment, so our average price is 112. After 3 months or 4 months, we realized that its price has fallen, or its price is falling significantly for some reason. It might be due to the market pressure and so on. So we realized and we set target that okay, if it falls below 100, then we might buy that. And after a certain time, we have funds available, and we realize that NetSol has in fact fallen to rupees 90. So we buy NetSol again at rupees 90 after studying that it has a good future, it has a good EPS, and it might start giving dividend. Its performance is improving. So we buy it at in March for rupees 90, and then our average price is 101 per share. We leave it to that, and we start monitoring it. But after 3 months or another 3-4 months, we find that NetSol's unit price is rupees 60. Now we realize that okay, it has fallen again, but the reason is that the market sentiment is very low. So market is coming down and people are selling the shares. But we realize that NetSol is doing very well. It is making new inroads into new markets, and its performance seems very good. The management is very good. It might give some dividend because it is earning good money, and so on. The dollar price has increased, so it means that its earning in rupees has increased. So it is still a very good company. It's a very attractive company. That was the reason that we bought it, and we are sticking with our assessment about NetSol. So we again buy it, and now the average price is 87.33. So we are looking at average price as our KPI to buy the share, because we want to bring the average price as much down as possible. Stock market will typically suffer from a lot of fluctuation. So averaging is a good strategy, but sometimes you are doing the averaging, and you buy a product at 112, 90, 60, and it keeps falling, and you are really worried. So averaging alone will not will not be enough to help you. There is another strategy that we use with averaging, and it is called stack reversal or part selling. So what you do in part selling or stack reversal is that you sell uh, your last purchase. So the last lot that you buy was for rupees 60, and the quantity was 1000, and there has been some positive movement on the stock. So in August 2019, the stock was at rupees 80. So you sell the stock at rupees 80, but you only sell 1000 shares that you buy in July 2019. So the last one, the transaction that is coming at the top is being sold for rupees 20 per share profit, and that means that we have 2000 shares left at average price of 91. Now in September, the stock again goes down. It is going through fluctuations, so we have a chance to buy 1000 shares again at rupees 60. So we buy those shares, and our average price is now better than it was. So for 3000 shares, now our average price is 80.66. Previously it was at 87.33. So now we have improved our average for 3000 shares, and then we see that in October again we have you know uh, the unit price of NetSol is again 80. Then we are going to again sell it for rupees 80, and that means for 2000 shares of NetSol we have average price of 81. So now we are doing comparatively very well against the market. So what we do typically is we sell our last lot if the price is higher than our buying, and we keep buying if we believe that share is doing well, and ultimately everything is going to be fine. Along with averaging and stack reversal strategies that help you average out your losses, or to improve your position, to get into a better position with time, you also need another very useful strategy, which is stop loss strategy. You use stop loss strategy in a situation where it is clear to you that a certain company, a certain share is going down and down, and the company has made losses, or government has made decision where it's not going to be very profitable in that business. In such a case, obviously, given the long-term perspective that you have, that okay, you need to get out of that share, and maybe you need to invest in some other share. So you have made a mistake and you want to get out of that mistake. So Shell is one example. I bought it for 350 and I averaged it out. Eventually my price was around 320 and so on, but I knew that it was going down and down. The share price in the market was around 230 to 40. So at some point, I made up my mind to get out of that share. So I sold it at that price. After I sold, currently the price is around, 150. So it means, I actually made a loss, but I also made a very good profit. I made, not really a profit, but I saved as much as I could. If I had sold it at 150, my loss would have doubled. So in that sense, yes, I saved my position, and I went into another share which started giving me dividend, and although and it is easier to average out because it has only a quarter of the price of Shell, so my position in that share is much better, and the company is much better. Right now it's giving me good dividends, so I'm happy with that. So the rule is that you don't want to stick with a sinking ship for too long, and you should remember that you can always buy that share back again. So for example, you sold something for 250, and if you can buy that share again for 150, then that's what you want to do. Eventually it would recover, and it would stop dividends and so on, and you can buy it for a good price as well, and that's what you want to do. Thank you very much. I hope you now understand which shares to buy, when to buy, how much to invest in stock market, and that would help you to feel more confident, uh, you know feel more assured that you are not behaving and acting like a blind gambler. So you are able to make good choices because you understand which shares to buy, when to buy, and if the market trend does not meet your expectation, then you really understand what to do. And if the market trend really meets your expectation, and you achieve your desired targets, then you know how to exit from the market. Thank you for the listening. Do like my video, do share it. Thanks everybody. Bye. Have a good